Nick O'Hare here. I'm an advisor with QSA Wealth and Wellbeing Management up here on the Gold Coast. Recently we put on an investment information night for our clients. We had two industry thought leaders and a world-renowned economist take the time out to come up and educate, so we're not just facilitating our investments for our clients. There was a lot of feedback from the night, great positive feedback. We thought we'd take the opportunity to share it with a broader audience by recording the night. So I hope you enjoy the night. If you do have any questions or feedback, or you want to get in touch because this piece does interest you and you want to find out if it's suitable, please do so. But on behalf of the team at QSA, hope you enjoy.
Welcome everyone tonight for our first inaugural seminar for 2018 on behalf of the QSA group. Welcome to the beautiful new Curra Surf Club. Thanks for having us here as well, Curra. We would like to put on nights like this throughout the year on a range of topics, as we see our role as more of an education process rather than just giving the advice. So we are going to invite thought leaders and industry professionals from different areas to come and present on key issues that we think are relevant to our clients. So we do have a feedback form, so if there is any other areas that you would like to hear about, let us know and we can organise that. We are also recording the presentation, as you can see, so if there's anyone you think would benefit from it or you would like a copy of the presentation, just let us know. An overview of tonight, it's obviously on our investment piece that we deliver in partnership with Implemented Portfolios, and we've got the guys from Implemented up from Sydney tonight. We provide the partnership because we believe it's the benefit to our clients and it delivers a superior service. So we've had the discussion with most of you in the room as to how and why we do this, and we thought it'd be good to have the guys from the other half of the partnership to come up and give you their perspective. You've probably heard enough from me over the journey, so tonight, as I mentioned, we're lucky enough to have two speakers. Santi Burridge will come up first. He's the founder of Implemented Portfolios, and he'll run through how he came to establish the service and the partnership program with advisors. And then secondly, we have Jonathan Payne. Jonathan will go around the world and discuss economic drivers and how that will affect your portfolio and hopefully what's on the horizon for us. Firstly, I'll ask Santi to come up. I'll give a brief bio first. Santi is obviously the founder of Implemented Portfolios. He founded the service to try and fix what he thought was wrong about the industry and how investors were treated about their investments. His peers recognised him for this service as Thought Leader of the Year in 2015. Santi is a proud Queenslander, but he currently resides in Sydney and is a long-term member of Manly Surf Club, so don't hold that against him. He's very passionate about investors being treated the right way, and hopefully that comes across in his presentation tonight. So thank you, Santi.
That's a fantastic intro. Thank you, Nick. As Nick mentioned, have a great passion for the industry, and I guess he's stolen a little bit of my introduction. I was a financial advisor, so I had 15 years as an advisor, and Implemented Portfolios was built for me. I actually never built it to be in front of you tonight. I was convinced the way we did things was wrong. I was convinced the way we treated our clients was wrong, and I was convinced there was nothing in the market that was focused on what I wanted to deliver to our clients. So I spent about 5 years trying to build it. It started in 2003. I spent 5 years getting it wrong, which for lucky you didn't know us back then, I guess. And about 2008 I got it right. I then decided as an advisor that my value had nothing to do with picking investments. And I decided to split this businesses up. So I still own an advice business in Sydney. I split that up, created Implemented Portfolios, and basically told Implemented Portfolios to look after my clients really well. Because I, as an advisor, saw my value had nothing to do with picking investments, but thought my value has everything to do with my clients and my relationship and that human connection I have with them. So it was a bit of a journey. I've been asked to be a little bit controversial tonight. I will. I have a lot of cynicism, but it's through lived experience. So please take that in good context. I am also just the undercard. And I'm really happy to say that. Jonathan Payne, who's on next, I only did about 20 minutes. Jonathan's one of the best speakers I know in Australia, and I'll give you a bit of an introduction on him before we go on. So, my challenge to you and challenge to myself was, and this might be confrontational to some of you, was we all know life is a journey. Some of us are better at it than others. But the entire financial services industry has been about product, a destination. I, as an advisor, can find a better product for you to make more money. I can make you more rich. The entire industry is built on that. That I, as an alpha male or alpha female, can find you something that's going to make you more money. And I came to realise that person doesn't exist. And I used to say that. They don't exist. There's no such thing. And what I also came to realise, and I came to realise this firsthand, but also research has backed it up. There's a group in the US called the Rydell Institute, probably never heard of them. They went and asked 300 clients who had been a client of someone like QSA for 20 years. And they asked them, what did they do to help you through life? Where did they make the difference in that 20 years? And the results were quite astounding. Less than 7% of those clients said their relationship with their advisor had anything to do with money. And 93% said their advisor added value to them in turning points in life. Marriages, divorces, children, schools, educations, moving states, moving jobs. That's when their advisor helped them. 93% of them said it had nothing to do with money. But we had built a whole financial services industry that is all about money. And pretty much the one thing we cannot control, we sell. The ability for me to make you more money than the next guy. They don't exist. And I'll back that up with some maths shortly. Now I went online to try and find the worst sign I could possibly find to prove my point. Now me and the banks don't get along very well. I've been fighting them for years, hand-to-hand combat. We're starting to beat them, which is great. And I reckon this sign should be at the front of all of them. And to be honest, you could put this on the industry super funds too. And I'm having a go at them all, and I'll tell you why. The thing that they sell to investors is a thing called a managed fund structure. Most of your superannuation assets, if you've been in an industry super fund, are in a managed fund. Most of your investments, if you've been with a bank, are in a managed fund. And if I was going to honestly pitch you a managed fund, honestly present it to you the way it should be, and I did this to myself in 2003, it would be like this. Today I recommend you invest in a product that provides you absolutely no transparency. You have no flexibility or discretion or control. Your after-tax outcome will be horrendous. It is very high cost, and we will let you know how you go after the fact. Does anyone want that? That structure is the greatest marketing success of all time. I can't think of a better marketing success. We will invest your money in a structure that cares nothing about you. Promise to care nothing about you. We know nothing about you. You are a unit number. Not only is it the worst marketing success of all time, the greatest marketing success of all time, it is also the greatest investment failure of all time. Can anyone name me an Australian fund manager, short or long term, I'll take either, that has outperformed their benchmark? It's okay if you can name me one. I won't be offended. I did this to a room of financial advisors this afternoon, and one guy, and there was dozen in the room, one person suggested one fund. They're in the industry. The reason why you can't name them is they don't exist. Of all fund managers in this country that manage your money, 99% of them underperform their benchmark. 99% of them. You would be better just putting the money in the index, and you will get a better outcome than paying them to manage the money. 99% underperform it. 1% obviously do. Can anyone guess, of those 1%, the longevity of them continuing to outperform over 10 years, another 10 years? 0. So not only do you have to be brilliant at picking the 1%, you have to know when to get out of them because their long-term outperformance doesn't continue. So this stuff became more, obvious to me as time went on, and you started to realise that we were trained as advisors in this country to sell product, really not to talk about service, and we used products that really had nothing to do with the client's best interests. We tried to flip it on its head, and we started with service. Today we recommend you invest in a service, not a product, that will treat you individually at every level, that provides you full transparency and control, that will care for your after-tax outcome. It is significantly lower cost, and instead of telling you after the fact what's happened, we'll let you know before we make a decision during and when. It sounded like the holy grail, but it was actually really easy. How could we flip that around and build a service for clients instead of product? And the notion I use is this. So you've all had experience with, I guess, salespeople over your lifetimes. Maybe some of you have been them. You sit in front of someone and you say, I can make you more than the next person. Alpha, we call it, right? Control alpha. I started thinking about alpha as being honest with myself. It's about the only thing I can't do. About the only thing I can't control is what happens in the market tomorrow. I have no idea what Trump's going to say tonight. I have no idea. I have no idea what the market's going to go to do tomorrow. And anyone says that they do have an idea, they're lying to you. And if anyone's going to tell you what's going to happen in the market the next year, they're probably lying to you. And if they're going to tell you what's happening in the next 5 years, you might start to believe them. 10 years, we take the view that they're probably telling the truth. It's very hard to understand short term. So what can we control? How could we build a service that ticked all the boxes? Well, for starters, that managed fund we talked about is a trust where you're a unit number. You're unit number 1, 2, 3, 4, that's all they know about you. If the music stops, if any of you have lived through 2008, you'll appreciate what I mean with the music stops. Sometimes the money just disappeared. When you needed it at the most, you couldn't get it. Why? The structure is the worst structure in the world. So no, every investment should be in your name. You should be able to pick it up and take it at any time. And honestly, this is the best advice I could give anyone. It has to be in your name. And that's the best testing you can have in comparison to being a unit number. Tax. Some of you, I'm sure some of you are retired, so you're probably less worried about tax. Some of you are still worried about tax. Why would you sell an investment you haven't held for 365 days? Because you know if you hold it for an extra day, you're going to save half as much tax. Fund manager doesn't care, doesn't know your tax position. Why wouldn't we have a service that cared for people's tax? Instead of selling it on the 364th day, sell it on the 366th. Pretty obvious stuff. Asset allocation. What does asset allocation mean? I'm going to spend a bit of time on this, and it'll segue into what Jonathan's going to talk to you about. As an advisor, I was trained to sell you product. Yep, that was my job. As the banks taught me to sell product. They never told me to put your money in the bank. Why'd I make money if I put your money in the bank? Why would I tell you to put the money in the bank? I've spent a lot of time travelling around the world meeting some of the best businesses I can find. I've done 16 of my own self-funded US travels, the US tours where I've gone and met businesses to try and understand what best practice does. And what the first thing they'll say when they talk to you about how they manage their clients' money, they'll say the first thing we want to do is if we invested before where we invest. Have a process to identify risk and opportunity before where you invest. Not which share we invest in. Do we want to be invested in the first place? That's what asset allocation is. I'm going to spend a bit of time on that. I want to argue that you are an individual and your preferences should be taken into account. Why is it that the fund managers, if we ethically don't want to own gaming or tobacco or mining, bad luck, you have to. A lot of people today care about ethical investment. So why shouldn't you be able to take that into account from your investment specialists to look after you? And lastly, I'm going to talk about education and communication and how we thought we could fix what we thought was broken. And again, I'm going to do this relatively quickly. This is not, this is a bit of education around why we built it, not so much what. So tax is the simple one. If you have investments in your name and you own the franking credit's the tax credit you get for companies paid, the tax that companies already paid, you'll make 1 to 2% per annum more. by just managing your after-tax outcome and owning the investment in your name in comparison to being a number in a trust. 1 to 2% per annum more. How many of those ads do you see what 1 to 2% per annum means to you over a lifetime? It's a lot of money. That's important. This one's more. We have a statute of limitations in the financial advice market. I'm telling you this now because I'm over it, because what I'm about to admit to you is an immense failure. This is a movie scene that best depicted what happened in my office in November 2007. So November 2007 is now the top of that, was the top of the stock market back then. From that moment on, all hell breaks loose. I know some of you probably lived it better or not. My experience was horrendous. And I'd written this article. I had met Jonathan Payne probably 1999, but we got to know each other quite well in the early 2000s. I started reading everything he was saying, and people like Jonathan Payne, actually, to be fair, Jonathan was probably the only person that I'm aware of that was telling investors there's a thing called a subprime crisis and get your money out. And he went on the record on this in 2006. So no if, no but, or maybe it was published in the press. He went out. So Jonathan's telling me there's a problem called subprime, never heard of about it in my life. Gone over to Miami to check it out, to understand exactly what it was. Another gentleman that we now work with, Tim Farrelly, was telling me things are looking scary. You should be getting your clients out. And I wrote this internal document to our team, said I called it the Prophet of Doom. We should sell all our clients' money out. What you don't know that happens in every advice business in this country that doesn't do what we do is that next conversation is a business decision. Santi, do you realise what you're saying here? If you are right, maybe you're right, you're probably wrong by the way, but we're going to have at least 300 meetings with our 300 clients. We're going to have to write 300 reports. We're going to have our staff writing reports for the next year. Our administration, all they're going to be doing is preparing paperwork to implement those changes. Probably going to take us a year to get to every client and implement all that change. You're probably wrong, don't do it. We didn't do it. It's too bloody hard. Nearly every practice in this country still uses exactly that same method that stopped us to doing it then. We wanted to act in our clients' best interest to protect their wealth, but we couldn't. It was too bloody hard. Amazing, right? So we wanted to fix that, and we did. And the way we did it started with questioning this process. You've never heard of this disease. It exists pretty much solely in Australia. I've defined it as she'll be right. Now I love Australia. I love surf clubs, I love everything about this country, and I love she'll be right. It's who I am. But it's nuts in relation to investments. Makes no sense. She'll be right is the way every Australian bank operates when they manage your clients, manage your money. This is a bank's largest fund that they operate. This bank has 3 letters in its name. You could interchange those 3 letters with any other 3 letters in Australia and you'll get exactly the same experience. You could put it at industry super fund and you'll get exactly the same experience. This disease no one is talking about. What you're looking at here in the blue is Australian shares, international shares, property, and so on. And what we're doing here is we've got a 4-year cycle from 2010 to 2014. Now, what you're not aware of is that every fund in this country has something called a mandate. Jargon. What is a mandate? A mandate says if BHP is 10% of the Australian index, then they have to own between 9 and 11% of it, even if they think BHP is good or bad. Now, one of my colleagues, Tim Farrelly, who used to work at Macquarie in 2000, was running their asset allocation. So he was deciding how their portfolios were invested. Now, I don't know if anyone remember 2000, tech boom? Yep. Anyone remember what News Corp was as a percentage of the Australian stock market? News Corp was the new tech company. Right? Rupert Murdoch, the new tech company. 25% of the entire market was News Corporation. So for every share you bought of the entire market, you got one quarter of it was News Corp. Extraordinary. It was 25% of our entire country's share market. They had a meeting. They all agreed that News Corp was insanely overpriced, that the market was going to bust. So they went underweight. They went from 25% to 23% because their mandate only allowed them to have 23%, at least 23% in the portfolio, or less than 2% of what their index value was. Where's the client in that? Surely if I think something's going to go bust, our clients would expect us to get out of it. Yep. It's pretty rational. No. Mandates. Every fund has one. This 3-letter one has a mandate. In 2010, the stock market was valued at 4,580, the All Ordinaries. 37.7% of your money was in Australian shares. A year later, markets dropped 10%. Australian shares dropped about 10%. They're charging 1.5% to look after your money here, by the way. A year later, the market goes up a bit. Now, we've just missed 2 years. We've had Europe nearly collapsed. The monetary union nearly collapsed. The US nearly collapsed. Nothing's changed. Market goes up a significant amount, so does the holdings in Australian shares goes down a little bit. Market goes pretty much sideways and their holdings in Australian shares go sideways. Their mandate says they must own between 34% and 38% of Australian shares, regardless of what they think of Australian shares. Regardless of what they think of international shares, they'll own the same, property and so on. They have to own it. Surely there are times when it makes sense to not own this stuff. Surely there are times like 2007 where you want to get the hell out of the way of an impending disaster. So as I briefly mentioned before, Tim Farrelly is on our team. Tim invented a process on his own. And this process was to help advisors and their clients find when impending disasters were coming and when impending opportunities were coming. And this is actually his process that he started in 2004. Orange is cash, purple's fixed income like bonds and so forth. Talk a bit about that, property and shares. And in 2003 and 2004, I don't know if you remember, the market's about to go up 25% per annum for the next 4 years. Wow. Time to invest. Have lots of this risky stuff. Don't own a lot of cash. 2007, get out of a lot of things. Build your cash. Things don't make sense. Markets have run. Valuations are looking silly. Get out of the way of an impending disaster. In 2009, what a time to invest. I'll talk to you briefly about that shortly. Get in. Have a process to identify opportunity as well as risk. And now, which is going to be the whole theme of Jonathan's presentation, what a time to be dynamic now. You can't just follow the herd. There is too much going on. We've had interest rates going down for 30 years until last year. What happens if they go up for 30 years? What's the reverse effect of that? Many of you remember 1987. So what else was important to us? Well, two more things before I pass over to JP. We hated the way the industry treated our clients. So guess what happens when you give your money to old Santi and most other advisors in this country? They send the check off to the fund managers, and what happens the next day? It's all in. 100%. Is that the right day to invest? Who knows? My emotional response personally used to be, God, I hope the market goes down for that client who's just given me their retirement savings so they can buy in cheaper tomorrow. Or geez, I hope the market goes up for that client that went in last week. And realised the whole common denominator of my entire approach was hope. And here I am acting as a fiduciary to care about your wealth, and my process is predicated on hope. Why is it that I could not choose to treat our clients individually and say, you know what, you are retiring. We do not want to get the day wrong. Let's do it over 2 years. Slowly move in, hold it in cash, take it patiently. You've just sold a large asset. Why put it in the next day? Slowly. Do things slowly and considered. Why couldn't we do that? Important. We decided to make that important. And also importantly, and this is a bit harder one to explain, why couldn't we send clients to where we're going, not where we are? So what do I mean by that? If we're convinced that News Corp is horrendous and we want to go to property, securities, something that's more defensive, then we might decide we're going to do that over 6 months. Do it slowly, considered, get out and move into the next. Well, from that moment we've made that decision, new clients don't go into where News Corp is. They start heading to where we are, heading to where we're going. Treat people differently. Don't pull them all in and everyone gets the same experience. And we thought that was important. Right? Again, I'm not talking about products here, I'm just talking there's a better way to be treated. This guy had to be fired. He still exists all around the world. We got to get him out. He doesn't add any value. We decided we were going to fix 3 little simple things at the end of this service. We were going to make sure we communicated better, that the clients were always in control, and we had a conversation earlier about that tonight, and that you matter. Never again were we going to wake up and hear that a fund is frozen. Any of you have experienced that? Experienced that in your investing? Property trust froze, mortgage trust froze. Never again. It's in your name. And we started with thinking about she'll be right, or she will be wrong. This was published in November 2007 to people like me, not you, telling us that Australian shares were looking very scary, get out. That international shares were looking very scary, start to get out. And property, this is commercial listed property, was looking horrendous. Anyone know what this dropped? 85% of your money. Within 14 months, gone. No one had a process to identify there was an issue there. That drops 50%. That drops about 20 because this Aussie dollar also collapsed. No one had a process to identify risk. We all only had a process to identify which product we'd invest in. And when it came to opportunity in 2009, which we published, proud to say we published this and our clients got it, it was the greatest time to invest. Qantas had a $1 sale on to New York. No, not getting on the plane, it's going to crash. Westfield have put 85% up. Everything's off 85%. People are running out of the store scared. It was the greatest time to invest and no one had a process. All we were trying to do then was stop people from selling. When in fact they should have been going, how good's this time to buy? 3,200. It's up 200% from now. Up 300%. We think up about 500% from that point on. Not which share we bought, we just buy the whole stock market. Buy the index, you've made 200%. No one had a process for it. And I think it was useful just to look back at last year because now we've got a brand new year. We published this to our clients in January 2007. Australian market looked quite cheap. It's now 6,200. Good year, plus dividends, a really good year you've had. There's been points over the last year, it's gone down to 4,700. Europe's going extraordinarily well, Jonathan's going to talk about that. USA, a bit scary a year ago, more scary today, and so on. And lastly, before I pass over to Jonathan, education. So the way we looked at it was we spent our entire life trying to educate ourselves, probably not so good. I've got a fellow school member in the audience, so we were just reminiscing on how bad we were at school. We go to university, we work it out, we spend time, all these parts of our life trying to get better, and when it comes to money and our investments, we look at our statement we get in the mail, we may go online, and we have an emotional response around that when we see that. We thought it was wrong. Why is it that the only time we have a conversation about our money is when we open the mail and have an emotional response? Because we're humans. So let's change it. We decided let's start writing to our clients every month, every quarter, every week, letting them know what's happening in their portfolios, educating you to not do what everyone else was doing, buying here and selling here. If we can just stop people doing this, wow, what an experience we're going to give you. But in 29th of July 2011, US debt crisis, one of the more embarrassing moments of my life. Briefly tell this story. I'm in Washington, DC, I've just flown in. The government shut down. So we just had another government shutdown, right? It's bizarre. They put fences around monuments. What's the monument's going to fall over? Like literally the Washington Monument's got a fence around it. They've shut down. So bizarre. I'm going through a run, haven't given it much thought, jet lag. Middle of Washington, cameraman there, lady. I'm stopping to look at the view. She said, can we have a chat? I said, oh yeah, sure. NBC. Didn't give it much thought. What do you think about the US debt crisis? I, don't say anything stupid, Sandy. Don't say anything stupid. Oh, well, a bit bizarre that the whole government was shut down over it, pretty ochre. Beamed into Channel 7 on Australia. I got my board shorts on and a pink singlet. Text message when I got back, oh, horrible. Anyway, We write this to the clients that morning. This is what the clients got from us. We may see the markets crash next week, but we got it under control. 18 months ago now, Brexit. That morning the stock market dropped to 4,600, just all ordinary, so it's now 6,200, only 18 months ago. So it's what, 30-40% since then, plus dividends. We wrote to clients that afternoon and said the team, including Jonathan, had got together and said, well, if this is a big thing, it's going to take years to play out, so any panic's going to be an opportunity to buy. You've received an email from QSA that afternoon saying we've got it under control. In comparison to, geez, I hope these guys are doing, you've got this under control. Or what are they doing? That team that we argue becomes your team. Now, remember, I've talked to you about not investments, I've talked to you about there's a better way. I've talked to you that you should beneficially own every investment in your name, not be pooled in a unit number. You should be treated individually for tax, that your ethical and moral views should be taken into account, that you should have a process to identify risk and opportunity before product, because product salesmen are dead and there is no such thing as a next best product. And I'm arguing that communication and education will give you better outcomes, not only with your money, but future generations. The team that looks after your money, who have become your team, and you can disagree with them, it's a bit of an intricacy of our service. If you think what Jonathan says is wrong, send an email to Nick and it doesn't happen. Paul was the head of Colonial First State's asset allocation, Colonial First State being the largest asset manager in Australia. Retired from there now. Tim Farrelly, head of asset allocation Macquarie, and founded the intellect of our service. John Riley is one of the founders of the business. Malcolm Palmer was the director of investments of a company called Tyndall, very, very big firm, but then joined his family business. And it's fourth generation family member in their business now, 145-year-old business. And Mark Wills is the head of Investment Services Group. These are your investment managers. If you're happy with what is done, it is done. At that, I'm finished. Are you going to introduce JP? Barefoot Investor.
I know we've spoken about this before. I probably agree with some of the money management side of things in the book, but the low-cost approach to managing the money, can you just touch on that? Probably not as much for the people in the room, but for the people listening as well.
So look, I've no personal gripe with the Barefoot Investor. So the Barefoot Investor is saying, basic his argument is cost equals value. So the lower cost, the more value. Now, some of you have run businesses, or most of you imagine if you have, you know that's not true. At a starting point, cost does not equal value. His advice to people is to invest in a very low cost fund in a strategy that I would define as she'll be right. And so maybe for a 20-year-old, it's a good thing. Okay, they've got a 40-year timeline, little money, they can ride through a 2008. But for anyone who's got wealth, what he is suggesting is nuts. She'll be right, hanging through market cycles, things will always get better, or they don't. And when you are retired and you're drawing a pension when the market's down 50% and you're experiencing that, you're probably selling. So the problem I have with it is I do have an empathy with cost equals value. Couldn't agree more, that some cost should be reduced. But geez, at no point has there been a discussion in that Barefoot Investor column around asset allocation matters, that having a process for risk, that you should treat people individually for tax, implementation, take into account your ethical views, your moral views. It's just shoehorned it into one portfolio and she'll be right. I don't think that's right. Would you agree? Mm-hmm. I will say before I pass on, I've worked with Jonathan Payne now for many, many, many years. We've done lots of presentations together. Much more interesting than me. Incredible knowledge. So take the opportunity to speak to ask him questions about what we're going to go through now. He's an integral part of that team that I referred to, and is a big reason for what we're doing right now. And it's your money we're caring for, so feel free to dive in. And thank you for the opportunity.
Well done. Thank you.
Forgive me, because his bio is quite long, so I do need some prompts. Jonathan obviously has 33 years of international investment experience, and he's led investment teams in London, Bahrain and Australia. He sits on the Asset Allocation and Investment Committee of implemented portfolios, and he has multiple degrees in economics and politics, as well as a master's degree in finance. He's a regular guest on CNBC and Sky Business News, as well as the author and publisher of the weekly Pain Report. He's well known for his independent and often contrarian views, and in numerous speeches and articles in 2006, as Santi mentioned, Jonathan highlighted the unsustainable levels of debt and the housing bubble in America, and respected commentators have since acknowledged his warnings of the impending crisis. Recently, one of his more controversial and contrarian calls was the prediction of Donald Trump would win the US election, and tonight Jonathan is going to take us around the world for a bit of an economic update, an outlook, and answer a few difficult questions we have for him.
Well, it's a pleasure to be here on the Gold Coast. It's a beautiful part of the world that you live in up here. I've often been very tempted to kind of quietly migrate up here. And by the way, you've played the Queensland card because Santi is one of the most loyal Queenslanders I've ever met. I'm going to play the same card because my grandfather was born in Queensland. In a place that you've never heard of probably, called Allora. Has anyone heard of Allora? A-L-L-O-R-A? Someone raise a hand. Yeah, I've got a few hands. So kind of Warwick way, right? Yes. So his father was one of the very first doctors in southeast Queensland. Came out in about 1850 or 40 or something. And he was Dr. Francis Payne. Payne, yes, I know, Payne, P-A-I-N, the real thing. And then my grandfather's Dr. Harold Cameron Payne, and he was born here in Queensland, and then he volunteered for the First World War. He was at Gallipoli. He was injured, one of the last to leave Gallipoli. And as soon as he recovered, he went back to the Western Front, got injured again, came back and went back again. And then he was that unlucky generation that got caught by the Second War as well. So, my goodness me. So, and that is basically how I ended up in Australia, because my father and my brothers then decided to come to Australia, and I've lived in 6 countries, and so here I am. I now call Australia home, and I thought I had to take advantage of a name like Payne, because obviously my brother's a doctor, right? So don't feel too sorry for me. My brother's a doctor, so obviously I had to make the most of that 4-letter word, Payne. What a Wonderful World needs no introduction, Louis Armstrong. And I think this next chart will hopefully demonstrate to you that it is quite extraordinary what we're witnessing. I don't think many people in this room have ever seen a global economy that is firing on all cylinders. So I'm going to walk back and have a look at it with you. The world economy has never been in better shape. What this chart does is it shows you the number of countries in the world in a recession. And as you can see, we've got virtually no countries in the world currently in a recession. In fact, can you name them? Santi this time has remembered the Penfold Grange, so it might be quite useful if you participated in the questions. You drank it again. That's you drank it. Okay, how many countries are in recession at the moment? I think Venezuela's one. We had an interesting answer at lunchtime. I think Zimbabwe we might, and I think the Central African Republic might be the third one. But the bottom line is we have the fewest countries pretty much in modern times that are actually in recession. Obviously, here's the great crash. Kevin Rudd, our former Prime Minister, actually coined the acronym GFC, Global Financial Crisis. If you use that term in Wall Street or London or Zurich, they won't know what you're talking about. They call it the Great Recession or the Credit Crisis or Great Credit Crunch. I actually have called it the WFC, the Western Financial Crisis. Why? Because not a single bank in South America, not a single bank in Africa, and not a single bank in Asia got into trouble. This crisis was born in the US of A phenomenon, and it spread like a virus through much of the world. It was a weapon of mass destruction created and made by the smartest and best wizards of finance in Wall Street. It's quite an extraordinary story, and numerous films have subsequently been made. So this is something we need to celebrate, but strong growth does have consequences. But let's run through, which is still the largest economy in the world, won't be in 5 or 7 years' time. There'll be another country knocking on that door. We have very strong growth in the United States. We've got very strong employment. In fact, tonight, I'm sure you'll join me, Santi, of course, will be, and I will be watching the mother of all economic statistics. It's my first confession. I'm a data junkie. I just love economic data. I'm a real nerd. I just really get a kick out of economic data. Tonight is non-farm payroll, the mother of all economic statistics. And the bottom line is this: the US economy is very, 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 very strong. And on top of that, we have a new president who managed with his colleagues on Capitol Hill to push through tax cuts. You have got highly stimulatory fiscal policy in the United States at a time when the United States is firing on all cylinders. This is very, very unusual. Very significant monetary policy since 2008, and now very significant fiscal policy with an economy that's really growing strongly. Tax rates cut back down to 21%. Walmart, the largest employer of private individuals in the United States, has just allocated bonuses to its staff. There are 67 companies now in the United States, major companies, that have awarded cash bonuses to their staff because, of course, they've got all this extra money to pay out. Companies in the United States, in my view, will actually start accelerating their increase in capital expenditure, and all of this is going to lead to even stronger growth in the United States. One of the big surprises in 2018, when the records books are closed, is how strong the United States economy is going to be. That will do this. It will generate higher wage inflation, which will necessitate a more restrictive US central bank. I believe the US central bank will raise interest rates 4 times in 2018. That will lead to higher bond yields, and this is important. We all know the book Fire and Fury, which has been the kind of the talking point in the United States and Washington in the last few months, and of course we have Trump truly. In about August or September of 2016, I asked my readers in my weekly pain report the question, what do you think the American electorate want? Entertainment or a documentary? If they vote for Donald Trump, they're guaranteed entertainment. The United States gave birth to reality TV. Does it not make sense that the United States will vote into the White House a reality TV star? Is that ridiculous? If you vote for Hillary Clinton, you're going to get a documentary. Much more serious, much more comprehensive, much more detail, a lot more thought. Well, we know what happened on Tuesday the 8th of November 2016. An extraordinary story if you think about the popular vote was lost by Donald Trump by 2.5 million people. He won the Electoral College vote, and as you know, 3 battleground states, Wisconsin, Michigan, and Pennsylvania, basically put Donald Trump in the White House. And if you add up the margin of difference in Wisconsin, Michigan, and Pennsylvania, Donald Trump was put in the White House via the Electoral College system by 118,000 votes. 118,000 votes. And the gentleman in the top left corner, who I'm sure is familiar to many of you, Steve Bannon, was the architect behind Trump's remarkable electoral victory against all the odds, against every pundit. There wasn't a single Washington political analyst who predicted Donald Trump would win. There wasn't a single political analyst on Wall Street that predicted Donald Trump would win. And guess what? Donald Trump didn't think he was going to win either. And we now know, and it's been pretty much corroborated by lots of different leaks from the White House, that the moment he realized that he had won, he went a ghostly pale color. The blood drained out of his face, and the entire family went, "You've got to be kidding." Anyway, Steve Bannon, the ultra-economic nationalist, just been fired. Kellyanne Conway, still in the White House. Reince Priebus, former chief of staff, fired. Anthony Scaramucci, head of communications, he's a hedge fund guy, investment guy from Wall Street. He's on CNBC with me. Lasted 8 days. We know who this is, Jared Kushner, the son-in-law, who's basically a very senior policy advisor to Trump. Rex Tillerson, former chief executive of ExxonMobil, now the US Secretary of State. I think he's about to go. Off the record, his ExxonMobil shares are just vesting, and now's an opportune time for him to retire. He has described the President of the United States in language I can't use in a public forum, but the second word was moron. On the record. Jeff Sessions, Attorney General. Used to be very good friends with Donald Trump. Donald Trump doesn't like him anymore because, of course, there's issues with the FBI, so on and so forth. The bottom line is I thought it was appropriate to use the Survivor reality TV backdrop to describe how come you get a beer and I don't? And I'm doing all the talking.
Schoolmates.
See, I wanted it to go first. I told you that, remember? Then I could drink watching you. He always does this to me, wherever we go. Well, the last one out, turn the lights out. Okay, this is really too esoteric, and I'm going to skip most of this. But this is the 10-year US Treasury yield. And you can see that in 1980, Santi should have told you to put all your money in 10-year US Treasuries at 16%. Did you give that advice in 1980?
Yeah, I was 5 years old.
You were 5 years old in 1980. Okay, that's all right, Sam. I forgive you then. That's about when I started working. So if you'd got all your money in 1980, you could have invested it for 16% and gone to the beach. Happy days, happy days. Of course, where are we today? 2.5%, slightly more than that actually as of a few hours ago, 2.73. My bottom line is that this decline in bond yields, the greatest decline ever seen in financial history, never underestimate the significance, because this is not barbecue conversation, and this is not the kind of thing I actually do try and say this to my friends, but they ignore me most of the time. This is the single most important financial variable in the world. The 10-year US Treasury note. The yield on the 10-year US Treasury bond. And this, in my view, is going that way. And that does a lot of things. One is it's going to start being of concern to the US stock market. This one is a little bit weird, but it's the Dow Jones. We all know the Dow Jones index is comprised of 30 leading companies in the United States. And your eyes are not deceiving you. It starts in 1900. I love charts. This one is now on the wall in my office. Why? Because in 118 years, and I reckon that's a reasonable period of time, in 118 years of history, we've just recorded a new high, and what this number is telling me, anything above 70 is classified as overbought or over euphoric, i.e. there's too much excitement. You saw Santi's valuation charts that go into the decision-making process with respect to the evaluation of various asset markets. You could see the colored charts, if you remember. On the left side, you saw that the Asset Allocation Committee of implemented portfolios view the United States stock market as being somewhat rich, somewhat expensive relative to its history and relative to earnings expectations. This type of analysis kind of substantiates and validates that kind of prescriptive analytical framework. Okay, now this is also an unusual one. I like to look at some kind of the internals of economic data. And what I'm showing you here is it's a survey of smaller businesses in the United States. Many, many thousands of companies, and they ask the question every month. What do you plan to do with compensation for your workforce? The data goes back to 1993. Basically, are you going to lift compensation or decrease? If you're a company and you're an MD and you're optimistic about the future, you're probably going to pay your staff a bit more. When you really get depressed, as one would have been in 2008 when the world was basically pretty much coming to an end in the United States, obviously compensation intentions and plans dropped like a stone. Subsequently, we are now back to levels last seen in 1999. What I'm saying is this. Businesses in the United States are finding it hard to retain staff and hire skilled workers. There is a massive shortage of skilled workers in the United States of America today, which tells me only one thing, that wage inflation is about to take off. Europe. It's a good news story. It's great news. No more riots in Athens, although I will say this, like every great Greek tragedy, we kind of know how it ends, we just don't know how long it takes. And at the conceptual core of every great Greek classic tragedy is this self-fulfilling notion and prophecy of doom and gloom. But the bottom line is what happens in Athens or indeed in Greece will not shape and define the topography of the global economic landscape. By the way, I love Greece. I was born in Africa. I went to school in Africa. Then my father insisted I went to university in England. The worst news I ever had in my entire life. I arrived in England in December 1979 to one of the coldest winters in British history. I nearly froze to death and decided I couldn't take it and went straight to the Greek islands. Eventually, unfortunately, my father found me 9 months later and I was eventually sent to university. I did everything I could to avoid university because the Greek islands were a lot of fun. So I love the Greeks. But what happens in Greece is not going to change the world, however much we love the Greeks. And yes, they were the birthplace of democracy. The good news today is most of Europe has recovered from the European sovereign debt crisis, and certainly the Greek debt crisis. And that's now creating a resurgence in the economy. It's growing at about 2.5%. I think this year the Eurozone bloc, if you take all the countries in the European Monetary Union, you're going to see growth north of 2.5%. And of course we know who Super Mario is. Mario Draghi, the president of the European Central Bank, is now even himself acknowledging the improvement in the economy. And my word, Mario is one of the most doom and gloom people on planet Earth. For 5 years, he's just been, it's like going to a funeral, listening to him speaking at press conferences. And now he's actually got a smile on his face, which is saying something. He actually retires next year, but he's going to be replaced by someone who is a bit gloomy as well, Jens Weidmann, who's German. But let's not dwell on that. Talking about Germany, it's overheating. The German economy is booming. And Germany is the locomotive of Europe. This is all great news. However, one of the byproducts of the strength in the German economy, the strength in manufacturing orders, the strength in German exports, and the shortage of skilled labor, familiar story. United States, shortage of skilled labor. Germany, shortage of skilled labor. What does it mean? Higher wages again. IG Metall, it's spelled IG, but they say IG Metall, is the largest trade union in Germany. And they're currently asking for a 6% pay rise. That's not very German. They're not going to get 6%, but they might get 3, they might even get 3.5%, and they're asking for shorter working hours. So the bottom line is there are some emerging wage pressures in Europe, but I want to say unequivocally, unambiguously, without any, what's the third word, equivocation. You were saying that today, Santi, I stole that line off you. That Europe is a really, really good story, and we should all hopefully celebrate that. Notice I haven't mentioned the UK. Let's not go there. Okay, the locomotive is overheating in Germany. This is the number of companies since 1985. It's a survey right across a range of different companies. The number of German companies that are seeing labor shortage as a factor limiting production. As you can see, back to 1985, we have the most number of German companies today saying that they just basically can't get hold of enough workers, and particularly skilled workers. That tells me, or reaffirms, what I've already been saying about the prospect of higher wages. And yet, we still have a European Central Bank that is injecting 30 billion euros of liquidity each and every month into the banking system. We have a European Central Bank that has a negative deposit rate. Yes, minus 0.4% on excess reserves held by commercial banks at the ECB. We have a European Central Bank that has been extending 3-year money. You can borrow from the central bank at the punitive rate of 0 for 3 years. Who wouldn't do that trade? That's the kind of stimulation we've had in Germany. So this is powerful stuff. And yet, all of the surveys, manufacturing, the business sentiment, economic sentiment surveys, are the highest we've seen, some in 48 years. The bottom line is the European economy is back on track, and we will see a commensurate increase in interest rates. When was the last time you saw a good news story on Japan? Do you remember the 80s when Japan was going to take over the world? You knew it right here in the Gold Coast. They bought pretty much the Gold Coast. They were buying a lot of assets, real estate assets up here. In 1980 to 1989, Japan was taking over the world. Everyone was going to graduate business schools learning how to manage companies and doing it the Japanese way. All of the textbooks and all of the business schools were talking about the superiority of the Japanese business model. How times have changed. Because, of course, Japan crashed in 1989. The stock market peaked at about, what, 38,500. Real estate prices in Tokyo fell, what, 75, 78%. So is it not good news to say today there is something different about Japan? And it's this very simple ratio. Profits, company profits, as a percentage of sales. One of the big criticisms of Japanese companies, and why a lot of global investors have not been attracted to investing in Japanese equities, is that Japanese management haven't put sufficient emphasis on return on equity, return on capital. They haven't really thought about profit margins. They've just thought about getting big, taking over the world, selling more cars than anyone else, air conditioning units than anyone else. That's all they were thinking about, was scale, not margin, not profitability. So what we see here is profits as a percentage of sales going back to 1955. You have to agree with me. Something is different about this chart in 2017. So basically, the profitability of Japanese companies has really begun to take off. This is good news if you're investing in the Japanese stock market. And the other thing is Japanese companies are starting to invest again. This is also good news. So what do I show you here? These are Japanese, that's real, so that's inflation adjusted, private capex, the amount companies are spending on new investment, new plant and equipment, new factories, investing in the future of their businesses. This goes back to 1994, and you can see what happened in Japan in 2008. This is as terminal as you get for a major economy. Japan's one of the world's greatest exporting countries, as indeed is Germany. Germany and Japan were wiped out by the big crash in 2008. Subsequently, we saw a bounce, but what we're beginning to see now is a continuation in the optimism of Japanese companies. I'll give you one more anecdote from Japan. There's a survey that's carried out every quarter. They survey about 1,700 major manufacturing companies in Japan, called the Tankan Survey, Tankan. That is at 27-year highs. So no one can tell me any longer that Japan is flat on its back. Japan is back. And wages are going to start rising, and we're going to continue to see a rising Japanese stock market. This is the Nikkei Dow, which is the top 225 companies in Japan. You could name the top 50 companies because you see them in your streets every day. The cars and everything else. Japan is a very, very high quality manufacturing nation. In fact, you'd probably argue you've got Germany, Japan, and South Korea, and Taiwan, funnily enough. This is the index of the Japanese stock market from 1970. You can see the insanity. This is the insanity. I came into the markets at this time. This is insanity plus. And then the crash, December 31st, 1989, 38,593. I got it wrong, 38,957. That there is 7,300. Imagine a market going from 38,900 down to 7,300. We're currently around the 24,000 level. So that's a long-term chart of Japan. Let's talk China. Completely vital. You can't have a discussion about the world You certainly cannot have a discussion about Australia any longer without some commentary around China. I am currently an associate with a Australia-based China think tank called China Matters. I think I can say this on camera. Our sessions are totally confidential. We have discussions with government, foreign policy, defence and the intelligence agencies here in Australia, and I'm not actually allowed to tell you anything more. So thank you very much for that. No, I can say a couple of things. So basically what we're looking at is the relationship between China and Australia, and we do a lot of analysis, both economic and political, on China. And my view is this, that the leadership of Xi Jinping, obviously, the president of China, and his premier Li Keqiang are at heart reformist. However, they also wish to maintain the total control, the monopolistic control of the Chinese Communist Party. Anyone who watched Xi Jinping at the all-important 19th National Party Congress, which extended Xi Jinping's tenure for an additional 5 years, would have surely been left with the impression that this is a nation that we could almost say has just celebrated its coming out party. Xi Jinping very clearly articulated the pride in the success of the Chinese economic model, but also implied a more assertive foreign policy role. And that's something that Canberra is paying a lot of attention to, and obviously Washington. We know the activities in the South China Sea. I'll make some very brief remarks on that. It's basically viewed as a fait accompli in Canberra and Washington. The laws of arithmetic tell me that Chinese growth will slow 5 to 6% over the next several years. I don't think that's a catastrophe. I think that's just a simple statistical reality, because you've got an economy that is now, nearly $12 trillion in size. So when your economy is that large, it can't sustain very high rates of growth. And I think in time, maybe 5 or 10 years' time, that number is going to be even lower. I still believe that China can manage this transformation of the economy, migrating it away from the kind of old, greater emphasis on heavy infrastructure and polluting industries into a more tech-driven, service-driven, consumption-based, household consumption-based model. I think that's important. I think in the next few years, the last thing China wants is any further problems with North Korea, and I will talk very briefly about that. Since 2003, I've said at every single speech and presentation I've made that the most significant and defining economic phenomenon of our lifetime, perhaps any time, is the rise of the Asian middle classes. And they will shape and define the economic landscape for decades and decades to come. And it's not just China, it's India, it's Indonesia, it's Vietnam, and other nations. Indonesia, the 4th most populous country in the world, 240 million people, hardly gets a mention in our media, and yet they're just across the water. We can go to Vietnam and celebrate a nation that rises like the phoenix from the ashes of a truly brutal history. It's an amazing story, what we're seeing in Vietnam today. And then India, the 2nd most populous country in the world. It's quite remarkable how much change is taking place in these parts of the world. And we're talking about more than 1/3 of the world's population in just 2 countries, India and China. And then you can throw in Indonesia and others, and you're getting up to 3 billion or 50% of the world's population. It's staggering stuff. Australia, characterised by strong employment growth. I think Scott Morrison has been talking about 1,000 jobs a day. Is that the number he keeps referencing? Strong employment growth. However, relatively stagnant wages. Contrast that with the view I have on the United States and Germany and Japan. So it's interesting that the workforce in Australia has had to kind of really suffer a more stagnant wage environment now for 7 years. I think we might see a little bit of upward pressure. But the bottom line is you've got high levels of household debt, strong employment, stagnant wage growth, and you're running the Reserve Bank. What do you do? So you're Philip Lowe, and you've got your respective governors around the table, members of the Reserve Bank board. What do you do? I think Philip Lowe keeps rates at 1.5%. I don't think he does anything. I think he would quite like to take a holiday for the rest of the year. 1.5%. I think, is what we would do, and I think it is what they will do until information significantly changes. Yes, it is a bit of a policy conundrum because we are seeing the slowdown in housing. You know, the Sydney market's rolled over. All of the data is confirming that now. We had some numbers this morning, CoreLogic, I think, down on the month. And the year-on-year rate in Sydney now is not much above zero. It's about 1.5%. It'll probably go negative. And the big story really is infrastructure, which we'll focus on in a minute. Australia is still an amazingly attractive destination for tourism, for migration, and education. These are really powerful drivers. Similarly, our agricultural sector, I'm very positive about. I do occasionally speak at Australian Dairy Board events, so I'm not just carrying the Australian Dairy Board kind of card, but I've long spoken positively about agriculture in Australia, as I have done in New Zealand for more than a decade. And you know, I wrote recently that Australian politicians are a bit like cicadas. You know, they make a lot of noise and they don't last very long. I mean, you think a cicada spends 7 years underground, then 2 weeks above ground, makes an absolute hell of a noise, and we largely ignore them and keep them in the background. But apart from our politicians, I mean, I think one of the positives I'll say about Australia, and it's appropriate given how close we are to the beach, that we have more beach per person than any other nation on planet Earth. This is a good news story. This is infrastructure. You see this real sharp increase in infrastructure spending projected forward 2018 and 19. All the different colours represent different projects around Australia. It's a pretty impressive story. And you know, we can criticise our politicians, and we all enjoy doing it, of course. But at the end of the day, I'm not quite sure whether it's federal or state or a combination of both. They've actually played this one quite well. Because Australia does require an improvement in infrastructure. It enhances productivity, and also the multipliers from infrastructure spending are very powerful. So if you spend $1 billion or $10 billion on infrastructure, the net contribution to the economy is probably 15 to 20 billion. So it's 1.5 to 2 times every dollar that's spent. So this is all very, very good news, I think. And this will serve to support the economy moving forward. I think the housing market is a question mark, and to me a red light in Sydney and in Melbourne, and also in Brisbane, incidentally, with an excess supply of apartments. And we're seeing some very significant price declines in apartments in Brisbane. So let's briefly go through some geopolitical commentary, and I'm going to keep this as light as possible because the subject is not light. Is it different this time with respect to North Korea? I'm afraid the answer is yes. The reason being, we have the emergence of Kim Jong-un, the dear leader of North Korea, came to power in 2011, and you can see that since Kim Jong-un came to power, he obviously changed something quite dramatically relative to what his father and grandfather had done. Namely, Kim Jong-un established unequivocally North Korea as a nuclear power, number one. Number two, he basically tested an enormous increase in the number of intercontinental ballistic missiles, and you can see that in the frequency of missile testing under his leadership. It's a statement, basically, to the rest of the world: you have to accept us as a nuclear power. That's the message coming out of Pyongyang. And it is very different because, of course, of the range. Everyone in the Pentagon and everyone in Washington and anyone in any military establishment in Canberra, in Britain, in France, in China even, are amazed at the advancement in the technology in terms of the missile capability of North Korea. Basically, much of the world now is within range, and more pertinently, the east coast of the United States, after the last testing, the missile that was tested. So what are the options? There are no good options. Talk to anyone in any military circles, there are no good options. What we've done with the North Koreans so far is basically contain them. My bottom line, I'm sorry to be a bit rushed on this, but my bottom line is all roads lead to Beijing. The solution lies in Beijing, because only one country can contain and control and effectively neutralize the North Korean risk, and that is China. It is virtually the only country that trades with North Korea. If you look at the geography, most of North Korea's border to the north is with China, Then right up in the northeastern corner, there's a very small border with Russia, but the great majority of all energy flows into North Korea come from China, and about 5 to 6% comes from Russia. Russia is not a key player in terms of the economic scenario with respect to North Korea. China could turn the lights out in North Korea tonight if it so wished. Since 1953, which was the cessation of the Korean War of 1950 to 53, and the separation of the Koreas, North and South, on the 38th parallel, China has used North Korea as a kind of geopolitical card to use at the table, to annoy the United States, to annoy its enemies in Japan. So the Chinese have played some very kind of cunning games with respect to the North Korean card that they've used. My strong view today is that North Korea is a serious pain in the backside of China. And I say that because if you were running China today and you just presided over the 30 most remarkable years of Chinese economic history, the elevation of 500 million people out of poverty, economic growth unseen in history, and you had emerged as a key part of the global economic jigsaw puzzle, would you risk your trading relationship with the three largest trading partners of yours in the world, namely the United States, South Korea and Japan, for the sake of trade with North Korea, which is not even a rounding error on the Chinese trade accounts? At the end of the day, the leadership in Beijing are pragmatic. They will not risk stability and prosperity and 30 years of remarkable prosperity for the sake of a despot in Pyongyang. So I still believe that China will be able to sort this problem out. The harsh reality in Vladimir Putin of Russia reminded us of this the other day. When asked the question about would North Korea give up its nuclear weapons, the president of Russia replied, the North Koreans would rather eat grass than give up their nuclear capability. Because the North Koreans, Russia says, have studied history. They say that North Koreans have said to them, look what happened to Saddam Hussein. Look what happened to Muammar Gaddafi in Libya. Once he'd given up his nuclear capability, he was overthrown. So the North Koreans are using their nuclear capability as a deterrent. And that brings us into the realm of Cold War politics. If you recall, the notion of mutually assured destruction, or as someone has said to me the other day, or just assured destruction. Will China sacrifice 30 years of progress? I don't believe so. So the alternative is simply unimaginable. We haven't got time to go to the Middle East tonight because I lived there for 9 years, and as Santi has known, I've bored him senseless for decades with my ranting and raving. I'm a student of Islamist politics. I follow radical Islamist groups very closely, and I spend a lot of my time thinking about it, but I don't need to introduce any of these people. But the calculus, the geopolitical calculus in the Middle East has changed very, very fundamentally in the last 12 months. And there's a great divide within Islam between Sunni and Shia. This is one of the big stories I think that's going to really affect our lives in the next 30 years. The electrification of transportation coming to a car near you. China and India are on track. Britain, France, there won't be any internal combustion engines basically sold post 2030 in France and the UK. So I think this is something that is going to be an amazing phenomenon in the next 25 to 30 years. In conclusion, the global economy is growing at the best levels we've seen in a very, very long time. We're going to see monetary policy normalization and an inflection point in inflation. Yes, I'm keeping an eye on North Korea and the Middle East, but at the end of the day, we're fortunate to say, what a wonderful world. Thank you very, very much for your time.
Jonathan, does anyone have any questions for him before I fire my Bitcoin question? No? Firstly, well, I guess I'll kick off.
Yeah.
We've had a lot of people coming in and asking about Bitcoin, other cryptocurrencies,
Yeah.
Bitbits, Bitwallet.
Yeah.
Firstly, what do you think the future
Yep.
of cryptocurrency is,
Yep.
and then secondly, probably more importantly, the technology behind that, blockchain. Seeing the ASX potentially moving towards
Yep.
that.
Yep.
So what's your thoughts on?
I'm going to answer the second bit first. Blockchain, I think, is a technology, I don't understand. I mean, Santi wants to speak on this subject in about a minute's time. He's an expert on blockchain. But it is something that fascinates me, and as you say, the ASX could be migrating towards it. So I think that's the fascinating bit about all of this, is the actual underlying blockchain technology. With respect to cryptocurrencies, the big daddy is Bitcoin. That's the one that's got the kind of household name. But cryptocurrencies are growing and proliferating on a daily basis. So there's today about 1,440 cryptocurrencies. So this ever-ending supply of new cryptocurrencies will ultimately undermine and devalue the kind of so-called scarcity issue of something like a Bitcoin. However, anonymity is a powerful currency. So you know that Crown Prince, I'm being taped, aren't I? I'm being taped.
Yeah.
So if you're a billionaire in Russia or a billionaire in Saudi Arabia, where do you want to put your money? You want to put it in something that no one knows that you own it. Anonymity is a powerful currency. And if you're a drug dealer or whatever, I mean, and you're trying to avoid tax, cryptocurrencies are pretty attractive. Other than that, it's an investment phenomenon, the likes of which we've never ever seen before. I cannot publicly even contemplate making a sensible, valid, rational, logical, half-decent prediction. And this is my prediction. Bitcoin in 10 years' time could be $1 or it could be $100,000. How about that? That's what I think.
Does anyone have any questions before we finish up? Oh, thank you very much, Nathan.
My pleasure.